Hello everyone, I'm Joey, and welcome back. Let me ask you something. When you hear a headline about Iraq scrambling to keep oil flowing, do you immediately think, that doesn't affect me? Most people do. After all, Iraq is thousands of miles away. The conflict is happening in the Middle East, and unless you work in the oil industry, it probably sounds like someone else's problem. But here's the surprising reality. A disruption in Iraq's oil exports can affect the price you pay for gasoline, the cost of your groceries, airline tickets, inflation, even your retirement account. Why? Because oil isn't just another commodity. It's the fuel that powers the global economy. And when one of the world's largest oil exporters faces serious supply problems, the entire world pays attention. That's exactly what's happening right now. As tensions continue to rise around the Strait of Hormuz, Iraq is racing to find alternative ways to move its oil, while the United States is backing new export routes designed to reduce dependence on that critical shipping lane. So, why is Iraq suddenly under so much pressure? Why does one narrow waterway matter so much? And why are investors around the world watching every new headline? Today, we'll break it all down. No complicated economics, no confusing financial jargon. Just the real story. And why it matters to your wallet. Let's begin. To understand what's happening, we first need to understand one simple fact. Iraq is one of the world's largest oil producers. Every single day, millions of barrels of Iraqi crude normally leave the country and travel to customers across Asia, Europe, and beyond. Oil exports are also the backbone of Iraq's economy. They provide the vast majority of government revenue. Without those exports, the country's finances come under enormous pressure. But here's the problem. Most of Iraq's oil doesn't leave through multiple routes. It depends heavily on one of the most important choke points in the world, the Strait of Hormuz. If you've never heard of it before, you're not alone. The Strait of Hormuz is a relatively narrow stretch of water connecting the Persian Gulf to the open ocean. On a map, it looks surprisingly small. Yet every day, a huge share of the world's seaborne oil passes through this single route. Think of it like a major highway. If traffic flows normally, everything works. But if that highway suddenly becomes dangerous, or partially blocked, traffic slows, delays increase, and everyone depending on that route feels the consequences. That's exactly what's happening in today's energy markets. Security concerns have reduced shipping activity, increasing uncertainty, and pushing oil prices higher as traders worry about future supplies. Now imagine you're the Iraqi government. Nearly all of your national income depends on selling oil. But suddenly, the main route used to export that oil becomes increasingly risky. What do? You start looking for alternatives. Fast. That's why Iraq has been working with regional partners and exploring new pipelines and export corridors that bypass the Strait of Hormuz altogether. The United States has also expressed support for reviving the Kirkuk-Banias pipeline as another possible outlet to the Mediterranean. This isn't just about logistics, it's about survival. For Iraq, every day that oil cannot move efficiently means lost revenue. And for global markets, every barrel delayed creates more uncertainty. Here's something many people don't realize. Oil markets don't wait for shortages. They react to expectations. Imagine a grocery store owner hears that next week's food delivery might not arrive. Would they wait until the shelves are empty before ordering more? Probably not. They would start preparing immediately. Oil traders think the same way. If they believe future supplies could become tighter, many begin buying oil before an actual shortage occurs. That additional demand alone can push prices higher. This is why oil prices often move long before consumers notice any change at the gas station. Markets are constantly trying to predict tomorrow, not just react to today. So, what happens when oil becomes more expensive? Most people immediately think about gasoline, and that's certainly part of the story. But gasoline is only the beginning. Oil affects trucking, shipping, aviation, agriculture, manufacturing, construction, chemicals, plastics, packaging. Even many products sitting on supermarket shelves depend on petroleum somewhere in their supply chain. When energy becomes more expensive, businesses often face higher operating costs. Some companies absorb those costs, others eventually pass part of them on to consumers. That's how an oil disruption can slowly spread throughout the entire economy. Now let's talk about inflation. Inflation doesn't suddenly appear out of nowhere. Sometimes it begins with higher production costs. If transportation becomes more expensive, moving food costs more. Delivering online purchases costs more. Flying products around the world costs more. Running factories costs more. None of those increases guarantee higher consumer prices. But together, they create pressure. And that's exactly why central banks monitor oil prices so closely. Energy has a way of influencing almost every corner of the economy. There's another reason investors are paying attention. Financial markets hate uncertainty. They can handle good news, they can handle bad news. What they struggle with is not knowing what comes next. Every new development in the Middle East forces investors to ask difficult questions. Will shipping continue? Will oil exports recover? Will prices stabilize? Or will the situation become even more complicated? Those unanswered questions often create volatility across stock markets, currency markets, and energy markets. Meanwhile, Iraq faces another challenge. Finding new export routes isn't something that happens overnight. Pipelines take years to build. Infrastructure requires billions of dollars. International agreements take time. Even if a new route is approved today, it won't immediately replace the capacity of the Strait of Hormuz. That's why governments across the region are searching for both short-term and long-term solutions. The goal isn't just to solve today's crisis, it's to make future disruptions less damaging. But here's the really interesting question. If Iraq eventually finds new export routes, could that permanently change global oil markets? Could countries become less dependent on the Strait of Hormuz? And what would that mean for oil prices, inflation, and the future of the global economy? But here's the really interesting question. If Iraq eventually finds new export routes, could that permanently change global oil markets? Could countries become less dependent on the Strait of Hormuz? And what would that mean for oil prices, inflation, and the future of the global economy? Let's continue. One of the biggest lessons from this situation is that the global energy market is constantly adapting. When one route becomes more dangerous, countries immediately begin looking for alternatives. That's exactly what Iraq is trying to do. Instead of relying almost entirely on one shipping corridor, it wants more options, pipelines, different export terminals, new agreements with neighboring countries. The goal is simple: reduce risk. Because in today's world, depending on a single route for billions of dollars in exports can become a major economic vulnerability. But building new infrastructure isn't easy. Imagine a city that suddenly needs a new highway. It doesn't happen in a week, or even in a year. Oil pipelines are some of the largest engineering projects in the world. They require international cooperation, environmental studies, financing, security, and years of construction. Even after they're completed, they still require maintenance and political stability. That's why the Strait of Hormuz remains so important despite decades of discussions about alternative routes. There's another question many people ask. If oil prices go up, why doesn't every oil-producing country simply produce more? The answer is more complicated than it sounds. Oil production can't always increase overnight. Some fields are already producing near capacity. Others require new drilling, new equipment, more workers, additional investment, and in some countries, political instability or infrastructure limitations make rapid expansion difficult. So even when prices rise, supply doesn't always respond immediately. This is one of the reasons oil markets can become so volatile. Demand changes every day. Supply adjusts much more slowly. That imbalance creates price swings, and because oil is traded globally, those price movements can spread across the world within hours. A refinery in Asia, an airline in Europe, a trucking company in North America. All of them are watching the same energy market. Let's bring this back to everyday life. Suppose oil prices remain elevated for several months. What might consumers notice? The first thing is often gasoline, but eventually, Transportation companies may face higher operating costs. Airlines could experience higher fuel expenses. Manufacturers may pay more to ship raw materials. Farmers could spend more on diesel fuel for machinery. Retailers might see delivery costs increase. Not every company passes those costs on to consumers. Competition matters. Long-term supply contracts matter. Productivity matters. But energy costs influence almost every sector of the economy. Now let's talk about inflation again. One of the biggest challenges for central banks is determining whether higher energy prices are temporary, or whether they begin affecting the broader economy. If oil rises for only a few days, the overall impact may be limited. But if higher prices persist for months, businesses may begin adjusting prices, consumers may change spending habits, inflation expectations can also shift. And those expectations matter, because when businesses expect costs to remain higher, they often plan differently, hire differently, invest differently. Investors are also asking another important question. Could this accelerate the search for alternative energy? History suggests that periods of high oil prices often encourage investment in new technologies. Renewable energy, electric vehicles, battery storage, energy efficiency, alternative fuels. When traditional energy becomes more expensive, innovation often speeds up. That doesn't mean oil suddenly becomes unimportant. Far from it. Oil remains essential for transportation, manufacturing, aviation, shipping, and countless industrial processes. But higher prices can influence long-term investment decisions. Another fascinating consequence involves global trade. Businesses dislike uncertainty. When one supply route becomes less predictable, companies often diversify. They look for additional suppliers, different transportation routes, alternative manufacturing locations, more inventory. All of these decisions cost money. But many companies believe resilience is worth the investment after experiencing repeated disruptions over recent years. So, is this only Iraq's problem? Not at all. It's a reminder of how interconnected the modern economy has become. A decision made in one country, a disruption in one shipping lane, or a conflict in one region can eventually influence consumers around the world. That's the reality of globalization. Our economies are connected in ways that would have been difficult to imagine just a few decades ago. Perhaps the biggest takeaway from this story is that markets don't simply react to today's events. They constantly look ahead. Investors aren't asking, "What happened yesterday?" They're asking, "What happens next? Will tensions ease? Will exports continue? Will alternative routes become available? Will energy supplies remain stable?" Those expectations influence prices long before consumers see any visible changes. For ordinary families, the most important thing is understanding the chain reaction. A geopolitical conflict creates uncertainty. Uncertainty affects oil markets. Oil influences transportation. Transportation affects businesses. Businesses influence prices. And prices affect household budgets. It's one long economic chain. When you understand that chain, economic headlines become much easier to interpret. No one knows exactly how the current situation will develop. Diplomatic efforts could reduce tensions, energy markets could stabilize, or new developments could create additional uncertainty. The future is impossible to predict with certainty. But one thing is clear. As long as the global economy depends heavily on energy, events in major oil-producing regions will continue to matter far beyond their borders. The story unfolding in Iraq isn't just about one country trying to keep oil flowing. It's about how fragile global supply chains can be, how quickly markets respond to uncertainty, and how decisions made thousands of miles away can eventually affect what all of us pay for fuel, transportation, food, and everyday goods. The next time you hear a headline about the Middle East, you'll know there's much more behind it than politics or military strategy. It's also a story about economics, global trade, inflation, energy, and the invisible connections that shape our daily lives. If you enjoyed this explanation and want more clear, fact-based videos about the economy, investing, inflation, and the global forces that affect your wallet, be sure to subscribe. Thanks for watching, and I'll see you in the next video.